We're seeing the markets sell off, and we've seen the markets sell off for a few days out, but certainly accelerating today based, I think, on some of the news around coronavirus in China and the measures they're taking right now. What's your take on what's been happening in the markets based on this news?
Yeah, so the first thing you have to look at the setup. Markets, as of today, are up 13% from the lows in October, so we've had a pretty good run. I would say we've probably got a little bit overdone, and the market is using this as a reason to perhaps reset expectations, bring down. I think we're off 2.5% from the highs now, and I wouldn't expect a few more percent to go, as we have in many ways this is a run-of-the-mill correction, although the driver of it is quite disconcerting, as pandemics are always unsettling.
Yeah, and I think that there's a disconnect sometimes people between the public health concern and what the markets, the interpretation of that. You and your team took a look at what happened in SARS the last time to the markets. Tell me a bit about what you saw in terms of the economy and what happened and how it played out.
Yeah, our research team spends a lot of time looking at history to try to understand today and just get a baseline of what to expect. So in 2003, we had the SARS outbreak. Some things that are similar, some things that are different. First off, China kind of avoided discussing this for months, so we really didn't know where it was coming from for months until they acknowledged what was happening. So there's a lot of uncertainty, and that really led to SARS becoming much worse than it should have been because of the lack of transparency. At the time also, valuations were quite a bit different. In the North American markets, we'd come off 2 years of recession after the tech wreck. And in the Chinese market, they were quite expensive. And so this time around, we've almost got the opposite, where North American stock markets were a touch rich. Chinese markets are actually quite cheap. And so the valuation starting points are quite a bit different. We saw the Chinese markets off about 18% through SARS, North American markets off 8%. I don't think that's a terrible guidebook this time around. So another 5% down in North America, I think, would be within the realm of expectations.
And you talk a bit about in the note as well too, is the reason we're seeing that suppression is, of course, you're going to see economic activities suppressed as they figure out what they need to do from a public health standpoint in China.
Yeah, this will weigh on demand. So we think about supply and demand and how the economy rolls. This will definitely suppress demand, particularly in the Asia region now for quite some time. Particularly in a time of year when there's a lot of people are traveling, Chinese New Year, seeing family, friends, spending money. That's all unfortunately not going to happen now, and so you'll expect to see some pretty weak growth data out of Asia over the next couple of quarters. Typically, the response afterwards, though, is you get a fiscal impulse, we call, or the governments will ultimately spend a bit more money to sop up that excess demand and get things going. And so, next few quarters, weak growth, followed by growth that would be stronger than expectations in the 3 to 4 quarters to come. That would be the playbook we're kind of playing by, and would fit with our expectations. Yeah,
and I think, as you mentioned, again, this is happening at a time when markets had been, some would say fully valued or fairly lofty at this point too.
It's more about the speed more than anything. So
tell me about that.
So last year, markets rebounded off the sell-off in late 2018. North American equities were up 30%. This year, we were up 4% at one point. So it's too far, too fast, and we're going to give some of that back. But ultimately, from our perspective, this is actually, from a pure market perspective, it's very healthy to have some of that excess come off. Because what we fear quite often is that we continue to go and we have a much more severe correction. I would much rather have a 5% correction now than a 20% correction a year from now if we keep going at this rate.
Michael, thanks very much. Great insight.
Thank you for having me.